Hello, folks. Welcome to Market Trends. I'm David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. As usual, I'm going to start off by showing some disclosures, and I'm going to add a few disclosures and other things into the chat. Now, we do this webinar every Thursday at 2 p.m. It's great to be with everyone. We show some of the things you can do at the TradeStation platform, some of the things happening in the market right now. Now, if you go to tradestation.com and you go to the Insights link at the top, will take you to our Market Insights blog. And that Market Insights blog will give you some other information that we're going to be touching on. Although I will mention that I think today there are some other things happening in the market that go beyond things that we've even covered in that blog post. Let me just get this off the screen. So first we want to start off by showing you some standardized returns because we are going to be talking about some ETFs here. And you want to look at those, we are providing in the chat a link to the disclosures and the prospectuses for those. If you want to look at those. And here on tradestation.com, if you go to Insights, you can see the blog post we're working off, which is this one right here. So, I mean, the first thing as I look here is that we, we start here with our MT main workspace that we always do. And, this is provided in the zip file that we have here. If you go up here and you grab this zip file and you import the ELDs and the indicators that are in there, you're able to see this workspace. So the immediate thing that kind of grabs my attention here when we really look on a one-day performance is utilities and real estate investment trusts, healthcare and consumer staples are green, and then everything else is red. The risk on cyclical is red. And, at this point, it's kind of, I think that there was some degree of anxiety in the market, just because the Fed meeting has happened. We're in this part of the summer now. But I would add that there's some additional things I think that are springing to life today. And I think if you look at the news situation in the Middle East, there are things that appear to look kind of like an escalation in the last 24 hours or so that could be rattling some nerves. And then in addition to that, we got some economic data now that was a little bit more potentially worrisome, in terms of being recessionary. This is the continuing claims of the jobless claim data. And you can see that this actually now has gone back to a pretty high level back here versus where it was in 2021. And this is when it was falling sharply. So, the thing is that we are seeing now more signs of kind of economic weakening, and it's kind of what the Fed wants to see. But at the same time, we're not going to see the Fed again for over a month and a half. So the thing is now, when you look at the situation, is we basically have a huge chunk of time during which the economy might weaken, and we basically have until September 18th before we get our next Fed meeting and the next potential for a rate cut. And I think a lot of people are now saying, why didn't they cut rates yesterday? Or I wish they could have cut rates yesterday. Because when you look at some of this data, like we're seeing today, like this piece of economic data, but there is some others. So for example, the Institute for Supply Management had its lowest reading since November of 2023 with weak new orders. And then also the initial jobless claims were the highest reading since last summer. Those are the claims that of new people going on to unemployment. So we have continuing claims higher than expected, initial claims higher than expected, a Fed somewhat, not utterly committed to cutting rates yet. And on top of that, we have basically a Fed that is, on vacation until September 18th. We'll hear something from Jerome Powell at the end of the month at the Jackson Hole sort of conference. But now we're entering a kind of month where August can often be a volatile month, and now we're entering a month with a declining number of kind of catalysts, and we're kind of going up on something of a weak note from this set of events and sort of activity. So I want to mention that. Now, if we look here at some of the other things on our basic key ETFs workspace where we want to start, we look in the last week, we can see here that we are seeing the leadership. Like I said, it's kind of utilities and REITs are starting to really move up. And you can see that we had something of a bounce in tech stocks recently, but now they are still remaining kind of here. When you look at tech stocks, they're remaining near the low in terms of the overall category. So the question is the overall rankings over different time frames in the last 2 weeks. Technology is still the worst performing sector. So if you look at the XLK or the Qs, they had a good bounce in the last day or two, but they're giving it all back very quickly. And I think here we're at a spot where people looking at the market overall, we see there's a period of time like in August or something, and then the question is that the market has made highs in August several times in the last few years. I'm going to get back to this, but let's take a look really quickly at the S&P here. Look at it. This trading view, but it's easier to bring this up really quickly. You can see this high occurred. I'm sorry, the S&P here, and let me go to a weekly. Wait, why is this not doing this? Sorry. But this high was this high that was in the summer, and then another high back here in 22. The high occurred in the summer. So our high both times for the year in 2022, and then again in 2023, July, August, and here we are, July, August. So I think people are kind of seeing that dynamic. They're seeing the space of time here. And the thing is, the market generally doesn't care about things like geopolitics that much. But I think when you take a step back and you recognize just kind of where we are politically and everything in the United States right now, the kind of uncertainty of essentially a lame duck president and uncertainty about a geopolitical situation in the Middle East and the Ukraine situation. So it's kind of tricky having a lame duck president, because the fact is, if you're a foreign country now, no matter what, you're going to have a different American leader in whenever the inauguration is 6 months from now or something. And so the question is, what does that look like? And what does that degree of uncertainty mean for the political situation? Does it get worse, or does it get better, or does it just, and we're not going to try and predict anything like that, of course. But the thing is it from the market taking a perspective and saying, well, maybe at this point there's just a lot more uncertainty. The market's had a good run at this point in time, and now we're facing some uncertainty between the economic data and between the political situation globally. You put all those things together, and it's just more of a you can understand why the caution is kind of starting to develop here. So I think that's these are things that were not as evident even 24 hours ago. The combination of economic data today and some of the news that kind of trickle out overnight, those things together, I think have created something of a different kind of day here. We have to recognize that given the fact it's August and new month and everything else, we might have to be on guard for things kind of being difficult in this month. Excuse me. Now I did want to mention here some of the all right, so I was just on my MT main. I like to kind of look at the sectors that are, how they're actually performing and stuff. And I mentioned about the safe havens. I think that was the most important thing to start with. And now there's something else with the semiconductor index I want to talk about here with the SOX or the SMH or whatever it is. But there's basically a level here from, I put on my notes around the this low, the 19th. Look at how we rallied up and basically stalled at that. Now look again at the Qs, for example. We have similar sorts of levels here, where if you look at this low from this time in around June 24th. So there's now like levels that are kind of coming into play that are we've given back like pretty much all of this. It's not like we kind of held at it. Earlier this week we did the market trend, the state of the market. It's a new webinar we do. We look at the major indexes and stuff, and we had essentially kind of said that we want that if the market, for people that want to continue buying, you'd want to see the bounce we are getting kind of get up above the short-term moving average, like the 8-day exponential or the 10-day simple moving average, and hold that and then turn higher. But at this point, that's not what's happening. So I think we also have to realize that if we look at the S&P here, we now have a bearish outside day, which is a reversal pattern. And then we still have the 8-day exponential below the 21-day. And I think at this point in time, it's also, look over here on this other workspace we've used some on this chart, the MT, I call it MT blog, but it's one I use for different articles I do. But basically, here we have this bearish outside day. We tried and failed to reclaim 5,500, and now we're kind of back in this range here. And I think this is now a point in time where um, there's simply time, like I said, and September 18th is a long way away. The summer is a long way away. The inauguration or the visibility or some kind of clarity on the global situation are potentially, a long way away. And if you kind of look out, it's a Thursday, then you have, Friday, the weekend. Will something happen globally in that time? These things are all now, I think, starting to percolate through people's minds. And then the question is also new month. And what happens when you have those people who are the longer term investors and they start to take a step back and say, well, they look at their portfolios over the weekend. Do we have a risk of, the kind of more selling next week? And I think that's kind of now more of a situation we need to be kind of thinking about. And so I wanted to kind of emphasize those as potential sort of risks, because this is a little bit different than I think we had before. For a long time, bad news was good news, but now we're at a spot where the risk is that bad news is bad news. And what I mean by that is the economy. Weak economic data was good news because it meant the Fed was going to cut. But now weak economic data is bad news because it means the Fed hasn't cut yet. And so that is a new kind of way of looking at things. Now, again, what's interesting is this rate of change indicator had given some interesting signals back here when it went really negative, and then it kind of stayed negative and it got that follow through here. And I think, we have to realize here that we might be something in that same situation where the 9-day rate of change now has not been positive for 2 weeks or something since the 17th of July. Now, normally this thing has been above. So I think what's important here to realize is that we're in this period of time where we're now kind of in a more prolonged trailing rate of change in the negative side. And that's, again, that's another sign that we could see a sort of intensification of weakness here and selling. So I did want to kind of point out that this indicator has worked in the past. RSI now has, it's kind of in the middle of nowhere. But the question is, you can say, hey, it's been a long time since RSI has gone oversold. Do we need to do it? Do we need to say we did it? Do we want to push it? And then the question is, that would obviously mean lower prices on the S&P. So I think that the point here is that we're at a spot where the idea of the market breaking out to new highs in August might be something that people have trouble with. So that's kind of the way these things are, kind of taking shape before me. It's a little bit more negative than I had been kind of initially the way things have been kind of looking. But I think we have to realize is that there has been a difficult geopolitical situation in the background that the market has been looking past, and the market's capable of doing things like this, and we'll ignore it for a long time, and then suddenly it becomes an issue. Also, next week we have fewer earnings. This week we had about 150 members of the S&P reporting. This next week we have about 80, and most of the big names after today, Apple and Amazon, will be done. So again, just kind of bear that in mind. So it's a point when the attention on the positive can diminish. We have non-farm payrolls tomorrow. At this point, I'm not even sure how massively important that will be. I think that a strong economic number, to me, if anything, it doesn't have a lot of real importance. I think the market is now kind of decided where it wants to be. A September 18th rate cut is pretty well expected. But then the question is are we now starting to worry about recession, which we really have not been worried about in a long time. The idea of like recession, it was something people talked about a little bit last year, but it was never in the market. You never really saw the companies that would struggle, that would be hurt by a recession, actually trickle through and take a hit. Now, I think it's important also to realize that, in my view, when you look at the data, and I think if you look at any serious economist, the idea of recession now is not really a realistic fear. It's more a question of, it's more of a fear now than it was before, and it's something that the market can act on and talk about, and it's a narrative that can take hold in the absence of earnings, in the absence of any other key data. So I think it's important just to realize kind of that's the way sentiment can behave. Especially when people look back and they have, the markets, it's been running for a long time. And you look at a lot of the big growth names that have driven that. People are now looking at more than, 12-month of upside, which means you're going to get long-term capital gains and things like that, and potentially more looking for people to be selling and stuff potentially. So all these are things now that kind of just come into focus, and I think that we could be entering a period of increased volatility, for a few weeks, and that's the main thing I wanted to mention about that. Now, another thing that is very interesting is we'll use it on TradeStation here to start. If we go over here, one of the other things we have here is our Treasury yields. They are here. Well, you know what? I took them off this updated version of my MT main. But if you go to $ TNX.X, 10-year Treasury yield really crumbling today. Now, in my view, this is going to, you want to know why there's not going to be a recession? Likely, in many ways, when you think about it, is this will pull through to mortgage rates, and we will see lower mortgage rates, and this will probably be a positive for housing and other parts of the economy. But I think it's important to realize that the 10-year Treasury yield is really breaking. At this point, it's hard to really argue that the market sees any upside risk in treasuries, in treasury yields. It's also important that yesterday the government put out their announcement of how much debt they plan to issue. I think in this quarter, probably, that whatever their next statement is, they do. I think it's every quarter, but basically it was no increase, and people were expecting an increase. And I think that we actually are going to see the fiscal situation probably actually improve. And in some ways here, we could be in a spot where things do kind of start to get better in some ways, in terms of our fiscal deficit and everything else. And I think that's an unusual thing. That's a longer term sort of thing. You're going to start to see these job gains, capital gains start passing through and improving our deficit. But that's just that's not as much of an immediate thing that's out there. I think right now we recognize that we have this chunk of time when things are not as favorable as they might have been. All right, so let's now look at this article. So a lot of these things were, like I said, they had looked like potential positives, but then when you get a kind of reaction like you do today, I think you have to realize that this is always a risk of a bearish pattern like that coming along. And then once you have it, you have to kind of just recognize that it's happened and move on from there. So again, this level 5402, this level that we had from back on June 13th, after we had that nice CPI report, that level is something people might be looking at that could potentially be in play here. So I think we just have to realize is that if you look back over here, this is now just chopping here, and well, I won't say even chopping, but we have this range. And I think the risk here is that people could even start to say it's a head and shoulder. I don't like head and shoulders patterns overall, but you can see we had a range that we broke out of, and now we're back in it. And if we break under it, it starts to do more sort of intermediate term damage to the chart technically. And I think that's another issue here, is that this sort of range, if it doesn't resolve higher, then that becomes problematic. I also want to point out that I've been looking at, I'm going to just bring it up over here, but the XLE, which I've been looking at a lot here, the industrial ETF. And I just want to mention this because, this is, to me, if this becomes like a false breakout, these are also sort of like, problematic sort of patterns. The industrials traded at relatively high multiples. And if people start to look out and think things are going to get worse economically, GDP wise, things like industrials here might be looking at a false breakout. And in my view, that's something that could have some real sort of, negative effect for non-tech, because the thing is industrials, financials they move in a similar sort of direction if you'll start to get worried about the economy. So to me, as I look at some of these different charts, especially things like the XLI, I do see the potential for things to, further price in this recessionary mindset. With a couple of months of time here before we get to, the potential sort of, rate cut and stuff like that, the market can look out and say, should industrials be trading at, record highs when we're worried about a recession? And then you have this range. And then the question is, does it even hold the range, or do people try and really step in and drive it lower? And I think that that's also something that, I'm seeing these ranges kind of form. And if this is a false breakout, I mean, that's something that could be a negative pattern where, it could result in a longer amount of selling and weakness. And I've been watching things like the financials as well. And, my view here, like the financials have a lot of fundamental positives that are kind of baked in. And so there's nothing here technically that's really been damaged on this, but it might be something where, have a few weeks of weakness, more if there is more volatility and weakness, it could be that financials will be the place that people want to come back to. And my perspective has been that financials here are in a spot where essentially this is the weekly chart of the XLF, but the financials are in a spot where their fundamentals have improved. If you look at some of the different data, that their net their lending margins and things like that. So I think financials are an area that people have recognized now are, you know, fundamentally they have turned the underlying, demand for credit and things like that, um, have the potential to increase because the debt to household incomes and all that are more favorable, and with interest rates coming down. So I think the question here might simply be, if we have a certain period of weakness, yeah, let's talk about that second half of the year. And as we think about what leads into year end, it could be something with financials of the area that have the most strength kind of later in the year. So I wanted to just kind of say that here. When you look at financials technically on like the weekly chart and stuff, they continue to kind of grind higher, but there's no real damage here that's been done. Um, so that's something important. I want to point out, I mean, I really think that we, the idea of a recession, from the things I can really see, I mean, it's a market fear. I want to be clear that there's no really particularly good data really confirming that yet. I mean, you can look at things like the ISM data, but honestly, the ISM data is all over the map. I have found it to be kind of less and less meaningful. And like I said, I believe one of the reasons for that is because healthcare is a growing percentage of GDP. Actually, I think distorts and it's making the economy stronger than people actually realize. And I think we saw that with the Q2 number. But again, people can be worried about stuff for now. From my perspective, there's not a lot of reason to expect that there will actually be a recession, but we could have a spot where the market worries about it for a while. But anyway, let me get back here to the bond yield, to the 10-year Treasury yield, because again, this is a little trading view idea I'm about to put out. But I think what's interesting here is that we see just, an accelerated, sort of, declines. And so from my perspective, this is a weekly chart. This is an old level we had going back to 2008, and we basically are now pretty much established below it. And so I think this is also telling us some interesting sort of things about interest rates. So, the thing is that the market really is worried about interest rates being too high. That fear is fading here, and this chart I think is helping to really confirm that. On Monday, we had actually talked about this accelerating decline in the 10-year Treasury yield, and it has more or less played out kind of as we had been mentioning. And we also said we didn't know which data point it was going to be. It turned out today that it actually was, maybe it was ISM that did it. Maybe it was the productivity number, which was very positive, in terms of any kind of inflationary thing. So, but regardless, we are now getting, I think, a pretty strong sense here from the Treasury yields of where, the borrowing costs at this point, um, are headed in a downward direction, which again, things like housing and things stand to benefit from that at a certain point in time. All right, so let's look at some of the other points I wanted to make, because there were some interesting things here. Now, I kind of done the same talking about small caps versus mega caps. And I would just say that I think a lot of the kind of positivity towards small caps is in a risk. If it does turn into more of a kind of geopolitical worries and recessionary worries, the entire small cap narrative in many ways is undermined by that. But here are some basic statistics that are kind of interesting. And I want to just kind of show you some of the ways that we found that using the platform. So if you look here at, MT main, I'm sorry, MT breadth. This is a workspace we have that gives you guys a lot of different sort of, internals of the different indexes here. And what you can see was that a large number of these companies in the Russell 2000, for example, were above the 50-day moving average. It was something like 75% of them yesterday were above the 50-day, and that was a much higher percentage than others. So these things can all kind of show you, the kind of internals. I want to just kind of remind people these are here. This basically shows the number of companies above the 20-day versus above the 50-day. It shows new highs and it shows the advanced decline line, also new lows. Um, so this is going to be interesting to see if this sort of level here, this is the IWM, can this level sort of hold on the Russell here? I mean, my thought observation would simply be that historically it would be unusual in an environment with spiking volatility and risk off. It would be unusual to expect that the Russell would outperform in that environment. So historically, that's it tends to be kind of the high beta version of what the market is doing to varying degrees. So I do think it's important to realize that. Um, the other thing I wanted to show you guys is that in this workspace here, in our MT main, we have these different. So some of the ways you can judge, um, trends is obviously by looking at different moving averages. Is the 5-day above the 20-day and things like that. So we have here this indicator called moving average order or MOV av order, right? So anyway, it allows you to kind of compare, and this tells us the different indexes where the 5 days above the 20-day simple moving average. That's similar to something like the 8 and the 21-day. Now, this works on radar screen, and it's useful because if we do something here like we load, I'm going to go to MA tools, and I'm going to load, just to keep my list simple, I'm going to load the Dow Jones Industrial to MA tools. And you can see here, this will give you a kind of sense of stocks where that now this is actually set to the 5, the 50 and the 200. It's a longer term sort of moving average. But what could be useful in this environment here is to be to right click on this and go to edit. Oops, we can go to edit, and then we can change it to the 5 and the 20, and this will give us short term indication of where trends are. And so I wanted to just kind of point this out because this is something that kind of allows people to see where the momentum is getting bullish or getting bearish. Sometimes it's useful just to have this up and say, like, I'm just not going to buy anything until that crossover occurs. Or it doesn't have to be the 5 and 20. It might be something else. But the key thing is that it gives you an objective measure of short-term momentum. And when we're in an environment where volatility starts to spike and things, and if there is a kind of follow through to the selling, it's one of these things where there's going to be, kind of increased volatility, and there will be days when things rebound sharply. But if you want to be focusing on the trend and the place that gives you that sense of near term direction, this can be a useful sort of thing to always look at a stock and just kind of say, where is that short term direction going? Where is that kind of short term trend? And this is a way to look at it across a large number of stocks. The other tool that we have is, I don't have it on here, but I'm going to add it, and I have given it to you guys. It's called um, 2 2MA ratio, and this one allows you to. This one can go on charts. You have this in your ELDs in your zip file, and this is set to work with the 8 and the 21-day exponential automatically, but you can change those things. And so for this, it allows you to just very quickly see. This basically divides the 8-day by the 21-day. And so if it's positive, it means that that's above. In this case, a stock like 3M, you can see it's it's really been jumping. And you can see that 8-day is way above the 21-day. So this is just another tool that you can use. And I think it's just kind of useful because when we look here at the overall S&P, we can see that um, well, I don't have it on this chart, but on this page, but it also is in a negative spot here. We'll go back over to our MA tools. If we go down here and we put in, for example, the the S&P, it has a negative, so simply waiting for things to turn to that positive direction can be useful in an environment like this. All right, so what is the ELB link? Is there a link to the radar screen up? All right, so what you want to do, and I'll just quickly do this and then I got to jump. We're going to do this webinar shorter on Thursdays, and we're going to do half an hour on Monday, half an hour on Fridays, just going forward. On Mondays, we are going to do look at the indexes, and on Friday and on Thursdays, I'm sorry, we're going to be looking at like the news and the trends and the things happening now. All right, so very quickly, if you were to click on this, you get to a zip file, and I'm going to show you what that zip file looks like very quickly. Um, all right, let me just go to, if you actually go into that zip file, it looks like this. And you go into the zip file, it'll have the folder MT public materials, and in there you have a series of ELDs, not ELBs. These include lots of indicators in them, and you want to load all of those. You double click on them. If you have TradeStation open, it will bring up a dialog box that looks kind of like this. You then bring in these are all those indicators. I already have them. I'm not going to do it. And then you bring them all in, and once they're all in, then you can double click on these blue things that are the workspaces. So that's the main thing there. The last thing I'll do is I'll take a quick look at this MTES, because what is interesting here when we look at this overall, this provides an hourly look. And I think when we look at this here, you can see clearly that we have, something here that people can start to look at as something like a bearish flag or something like that. So again, if the market wants to stabilize here, people will probably give it some, they'll wait for some time for that to happen. But also, I think we're at risk now of something where, given the beginning of August and this chunk of time and the uncertainty that's out there, people might be more in a spot where, this turns into more of a sort of a more of a period of anxiety, especially because in August, it's just a dead space in time. And with people having gotten some good gains, it could be a time we see increased volatility. The last thing I'll mention is that in a period of increased volatility, it can often be useful to have fewer symbols and focus on the bigger indexes more, and the individual stocks can be less useful because in a period of increased volatility, there's more correlation. So the market goes through cycles of volatility, as we've discussed at different times, and we could now be entering a period where we're exiting complacency and we're entering correlated volatility. And I just think that's important to recognize. And it means, it can make sense to have fewer symbols, fewer positions, and focus on the big indexes more. Where can I get that ELD? Will it work on 9.5? I do not believe it will work on TradeStation 9.5, I'm afraid. But if you go to tradestation.com and you go to Insights, and then you go to this blog post that we have here called Megacaps versus Small Caps, there's a link at the top. We also have our link to the next state of the market if you guys want to check that out. We'll see you on Monday afternoon at 3. Hope everyone has a great day and a great weekend.